All right, so we've got a pretty hefty stack of reports and analyses all about Metro Brands Ltd.
Yeah, it looks like someone's really interested in the Indian footwear scene.
Well, you know me, Tans. Got to stay on top of those fashion trends. But seriously, these reports paint a pretty interesting picture of MBL and their plans.
Definitely. I mean, they're not just aiming to be another player in the market. They're going for a dominant position.
Yeah, from what I've seen, they're not afraid to be a little bit different.
Right. They're mixing things up with their own brands and these big global partnerships.
It's like they want to be the one-stop shop for every footwear need.
You hit the nail on the head. They're trying to cover all their bases. You see this in how they try to appeal to the entire family with brands that go from like the high-end stuff all the way to more budget-friendly options.
So casting a wide net, that's a good way to put it. But what's the actual strategy behind all this?
Well, that's where things get interesting. The reports mention what they call a three-pronged approach to growth.
3 prongs.
Okay.
I'm intrigued.
The first one's all about aggressive retail expansion. They're aiming for over 1,000 stores across India by the end of FY 25-26.
Wow. 1,000 stores. But isn't retail kind of a tricky business these days? Are they just opening stores everywhere, or is there some strategy behind this expansion?
Oh, they're definitely not just throwing darts at a map. There's a very deliberate strategy at play.
Okay, so what's the method to their madness?
It's all about being targeted. For their premium brands, they're super picky about location prime spots only, but for the mid-market brands, they're going for wider coverage, trying to really grab market share.
So 2 different approaches within the expansion makes sense.
Yeah.
What's the second prong of this growth plan?
This one's all about building a strong brandscape. It's about finding that sweet spot between their in-house brands, which give them better margins and control.
Right, because they own those brands outright.
Exactly. And then they're also doing these strategic partnerships with global brands to make sure they're covering all the trends and what customers want.
So not putting all their eggs in one basket, spreading the risk, smart. What about the third prong?
That's where those global partnerships come into play. We're talking long-term agreements with brands like Crocs, FitFlop, and Fila.
Those are some big names. It seems like they're not just passively collaborating with these brands, though. They made a pretty bold move, didn't they? Something about acquiring a company.
You're talking about the Cravatex Brands acquisition, which they've renamed Metro Athleisure. This was back in 2022, and it gave them ownership of the Fila and Perline brands in some key Asian markets.
Yeah, that one. It seems like they're really serious about tapping into that whole sports and athleisure market.
You bet. Especially in India, projections show that market could grow at a compound annual growth rate of 16% all the way through FY25.
So they're getting ahead of the curve there. Smart move. All this growth is impressive, but are they actually making money? I mean, are they just growing for the sake of growth, or is there substance behind it?
Oh, they're definitely making money. But like any business, their story's got some twists and turns. Their financials overall are really solid, but they did see their EBITDA margin dip a little bit in FY24.
A dip in profitability. That doesn't sound good. Should we be worried?
Not necessarily. The reports say this contraction was mostly because of lower productivity, which kind of messed with their operating leverage.
Okay, so a bit of a hiccup. But is it a sign of bigger problems?
It doesn't seem like it. Analysts are actually predicting their EBITDA margin will bounce back to 21.6% in FY26 and even hit 22.2% in FY27.
So temporary setback. Got it. But we're talking about more than just profit here, right? What about their overall financial health? Are there any other signs that tell us they're managing things well?
Absolutely. One good indicator is return on equity, or ROE. A healthy ROE can change depending on the industry, but generally anything over 15% is a good sign. MBL is sitting pretty with an ROE of 24% in FY23.
Okay, so they're making good use of their investors' money? That's a plus. What about other indicators?
Another important one is return on capital employed, or ROCE. This basically tells us how efficiently they're using their capital to make money. MBL had an ROCE of 18% in FY23.
Another good number, it seems. So 2 strong indicators that they're on top of their finances. But let's not forget, they're not operating in a bubble.
Right, gotta look at the competition.
Exactly. How do they stack up against all the other players in the footwear market?
Now that's where things get really interesting. Well, think about it this way. When you walk into a Bata store, you're kind of hit with that Bata vibe, right?
Yeah, Bata everywhere.
But Metro store, it's different. It's curated. They mix their own brands with those global partners we talked about. Creates a totally different experience.
So it's less about pushing one brand, more about offering choices, appealing to different people, different budgets. Does that tie into their store expansion plan?
Absolutely. They're not just copying and pasting the same store everywhere. They're Metro stores, for example. Those are their multi-brand outlets aimed at the mid to premium segment.
So they're going after those shoppers who are a little more fashion conscious and willing to spend a bit more.
Exactly. And then you have their other brands, like Mochi think younger demographic trendy styles, but at a price point that doesn't break the bank.
Makes sense. And what about Walkway? I feel like that name screams comfort and practicality.
You're reading my mind. Walkway is all about value, footwear for the whole family, and they keep the prices competitive. I think this brand's going to be crucial as they expand into those smaller towns and cities where people might be watching their wallets a bit closer.
Makes sense. Okay, so they've got their brands figured out, but can they actually pull off this massive expansion? 225 new stores in just 2 years. That's a lot. What makes them think they can handle it?
Honestly, what really impressed me in these reports is their focus on store economics. They're not just throwing open doors left and right, they're super strategic. Remember, they closed 21 underperforming stores in FY24?
Right, they're not afraid to cut their losses.
Exactly. And at the same time, they opened 118 new ones. That tells me they're willing to adapt to make the tough calls to make sure their stores are actually making money.
So it's about sustainable growth, not just growth for the sake of growth. Are there other signs that point to them being financially responsible with this expansion?
Well, look at their track record. They've been growing steadily for the past few years, added a net of 250 stores between FY22 and FY24.
So it's not a sudden crazy rush to expand. They're taking it one step at a time.
Exactly. It makes me think they have a solid system in place, a way to really assess those new locations and keep costs in check.
Like they're taking calculated risks, not just gambling on every new store. Now let's get back to those global brands for a second. One report really dives into their Crocs partnership, which seems to be a huge win for them.
Oh yeah, Crocs has been a home run for MBL. It grew something like 19% between FY19 and FY23.
It's funny, isn't it? A few years ago, those colorful clogs were kind of a novelty. Now they're everywhere. But MBL, they saw the potential early on.
They've got a real knack for spotting brands that click with their target market, and then they weave them right into their stores. It's a win-win. Customers get the brands they love, and MBL gets more people walking through their doors.
More foot traffic, more sales. Everybody's happy. And it's not just about Crocs, right? Their acquisition of Cravatex brands, which is now Metro Athleisure, shows they're really going all in on sportswear, especially with Fila.
The Fila deal is interesting. It gives them way more control over the brand. It's not just importing and selling whatever Fila sends their way. They can adapt designs, change sourcing to really fit the Indian market.
So they're not just slapping a Fila logo on everything and calling it a day. They're putting in the work to make sure it actually resonates here.
Exactly. It's a bold move. Fila's a global brand with a strong image. But MBL's not afraid to tweak things to make sure it works in India.
Smart. Okay, so they've got the brands, the stores, the partnerships, but all that goes out the window if they can't keep their costs under control, if their margins start shrinking.
You're right. Costs are crucial. And one thing that jumps out from the reports is how they're really trying to optimize every aspect of their business. For example, their rent costs are incredibly low, even with all this expansion.
Rent's a killer for retail. How are they managing that? Are they just really tough negotiators?
It's more about being strategic. Where they put their stores matters. High traffic areas, good lease terms. They're not just settling for whatever space is available. They're being picky.
So thinking long term, not just about saving a few bucks on rent today, but making sure each location has the potential to really perform down the road. What about other areas where they're watching their spending?
Their advertising expenses caught my eye. They were surprisingly low in FY24.
So they're not just throwing money at ads, they're making every rupee count.
Yeah, it seems like they're being very data-driven with their marketing, making sure those ad dollars are actually bringing in customers.
Smart approach. But what about employee costs? Those have been going up, haven't they?
Employee costs are definitely on the rise. But a good chunk of that is variable cost tied to sales. So as sales go up, so do some of those employee costs, but it's not just fixed salaries across the board.
So it's like a performance-based system. They're investing in their people, but they're also making sure those costs are flexible, tied to how well the company's doing.
Exactly. It's a good way to keep things balanced. All right, so we've talked about how they're managing costs, but are they really as efficient as these reports make them out to be? Is there a way to actually compare them to their competitors and see how they measure up?
That's what I'm wondering. There's got to be some way to see if they're walking the walk, not just talking the talk.
Well, luckily for us, one of these reports actually does a deep dive into their key performance indicators, or KPIs, and they even benchmark those KPIs against their competitors. So we can see exactly how they stack up against the big players in the market.
Perfect. Let's get into those KPIs and see how MVL really measures up.
So when we talk about KPIs for retailers, one of the big ones is inventory turnover.
Inventory turnover. What exactly is that?
It basically tells you how quickly a company is selling its products.
Yeah.
So you want to see them moving those shoes off the shelves and out the door, not piling up in a warehouse somewhere.
Right. Makes sense.
Also,
So the faster they sell stuff, the better their inventory turnover.
Exactly. And the good news for MBL is they're killing it in this area. Their inventory turnover ratio is way higher than some of their main competitors.
So they're really good at predicting what people want and keeping their inventory fresh.
Yeah, they're not letting those shoes get dusty. And there's another metric that's really telling. It's called sales per square foot.
Sales per square foot. What's that all about?
It tells you how much money they're making from each square foot of their store space. So it's all about using that space effectively.
Makes sense. So are they cramming stuff in, or are they making each square foot work for them?
They're definitely maximizing their space. Their sales per square foot are way higher than a lot of other footwear retailers.
So they're not just opening stores for the sake of it. Those stores are actually bringing in the cash.
Exactly. And I think a few things are driving that. They're really strategic about where they put their stores, so they're in high traffic areas.
Right. Location.
Plus, they have a great mix of brands that attracts a lot of different customers. And then on top of that, they're good at merchandising and sales strategies. They know how to make those sales happen within each store.
Sounds like they've got a winning formula. But so far, we've mostly talked about new stores. What about the stores they already have? Are those doing well too, or are they just relying on new openings to drive growth?
That's where same-store sales growth comes in. It's a metric that only looks at stores that have been open for at least a year.
So it tells us how much their existing stores are growing, not just the new ones.
Exactly. And the reports show that MBL's same-store sales growth has been consistently strong, even with more competition and the economy being a bit shaky.
So people like their brand and they're coming back for more.
Yep, it shows they've got a loyal customer base.
That's great news for them. All right, so we've seen that they're beating the competition in areas like inventory turnover and sales per square foot.
Mm.
And their existing stores are doing well too. But let's get down to brass tacks. How do they actually measure up against their biggest rivals, like Beta and Relaxo?
Well, Bata and Relaxo are like the titans of the Indian footwear market, right?
Yeah, they've been around forever.
And they both have their strengths. But when you look at certain areas, MBL seems to have a real edge.
Let's start with Bata. How do they compare when it comes to efficiency and profitability?
Well, like we said, inventory turnover is key. And in that department, MBL's blowing Bata out of the water. They're moving their inventory way faster, which means they're more efficient and they're less likely to end up with a bunch of old stock they can't sell.
Makes sense. And what about sales per square foot? Are they using their space better than Bata?
Definitely. Their sales per square foot are significantly higher than Bata's, so they're making more money from each store.
Seems like they're running a tighter ship. What about Relaxo? How do they compare?
Relaxo's a bit different because they're more focused on the mass market, affordable shoes for everyone, while MBL is more in that mid to premium range. But even taking that into account, MBL still beats Relaxo when it comes to inventory turnover.
So even though they're going after different customers, MBL is still more efficient.
Right. Relaxo might be selling more shoes overall because they're targeting a wider market, but MBL's really focused on making sure their operations are as profitable as possible.
Smart. So it's been quite a journey, huh? We started with this stack of reports, and we've really gotten to know Metro Brands inside and out.
Yeah, we've seen their business model, how they compete in the market, and what their potential for growth looks like.
I feel like I could walk into a Metro store tomorrow and really understand what they're all about.
That's the goal. But even with all this information, there's always more to explore. We've talked a lot about where they are now, but what about the future?
Right. What does the future hold for Metro Brands? Can they keep up this momentum, or are they going to hit some roadblocks along the way?
That's the million-dollar question. But I'll leave you with this thought. As you watch MBL, keep an eye on how they adapt to changing tastes and those economic uncertainties that always seem to pop up. And of course, you got to watch out for the competition both here in India and from those international players. The footwear market's always changing. Who knows what's next for Metro Brands?
That's a great point. Thanks for taking this deep dive with me. It's been really insightful.
My pleasure.